In this video, we continue our discussion on capital asset pricing model and start talking about the building blocks under the capital asset pricing model, the key ingredients of what goes into the capital asset pricing model. Right now, we have already discussed why a hurdle rate is necessary and how do we arrive at a risk return framework and why CAPM is one of the most commonly used frameworks that is available. Let's, before we go ahead, discuss the broad limitations of capital asset pricing model. Right now, the basic criticism of CAPM is that it makes some sort of unrealistic assumptions. What are those assumptions? It makes assumptions like there is no transaction cost, right? It makes assumptions with respect to marginal investors being well diversified. We have seen this earlier. It makes assumptions in terms of lending and borrowing with respect to the risk-free rate. You could borrow and lend unlimited amounts on risk-free rates. The second problem that comes with CAPM is when you're calculating data around some of the parameters such as risk premium or some of the parameters such as risk-free rate or the beta. You could have a problem with what is the market index chosen. Whose returns are you looking at when you are trying to calculate some of these? And finally, remember the model basically says that the expected return is nothing but the risk-free rate plus beta into the return on the market minus the risk-free rate, this being the equity risk premium effectively, right? Now, if this were correct, then there has to be a sort of a linear relationship between the expected return and beta, right? So there should be a linear relationship in practice when you see that. Theoretically, that is what CAPM tells us, but in reality, betas are not able to explain stock movements. There are a lot of other variables like what is the size of the company, what is the price to book value, what is the valuation. We'll discuss some of these as we go along, but basically some of the other risk parameters explain differences in returns better, right? So for example, typically a high beta stock should show better performance over a period. Now, what are high beta stocks? Metal companies, right? The likes of Tata Steel, the likes of Hindalco will have a high beta, right? Even real estate companies, the likes of DLF, etc., will have high betas. Now, it is expected that these companies will perform better over a period of time, but history does not seem to suggest so. So while CAPM is a simplistic model and we kind of use it, it is always useful to be aware of the issues that CAPM faces in real life, right? Let's then go ahead and now break it down into its three major components, and this particular section is going to talk about the first component, which is the risk-free rate. So there are three components: the risk-free rate, the equity risk premium, and the beta. We are saying the risk-free rate is the rate that is anyway regardless available to us in the markets. If we want to invest in the equity markets, we want an extra return for taking that extra risk that's given by the equity risk premium, and then individual stock specific risk that comes to the portfolio is what is called as the beta, right? So we need three major inputs. The first input is the current risk-free rate. Note the emphasis on the current risk-free rate that is needed. The second input is the expected market risk premium, not necessarily historical risk premium. This is the premium expected for investing in risky assets, the market portfolio versus the riskless asset, right? And then the beta of the asset being analyzed or the stock that is being analyzed. So that's what is going to kind of give us broadly what is going to be the expected return. Just simplistically speaking, if we say risk-free rate is 10%, just for argument's sake, and we are saying equity risk premium is 5%, just for argument's sake once again, we are basically saying that a stock which has a beta of 1 will give us a number of 15%. We are expecting a 15% return there. A stock which has a beta of 0.5 will be 10% plus 0.5 into 5%. So we will be happy with a 12.5% return there. And a stock which has a beta of 2, we would want a return of 20% on that, right? So we perceive the risk as higher. That's the broad contour of each security, and each security will be defined by one single parameter, which is the beta, right? Now let's focus our attention on the first parameter which we are looking at, which is going to be the risk-free rate. So let's define risk-free rate as we go ahead, right? Now, can some asset really be risk-free? What do we infer by risk-free? Now, when we look at the risk-free rate, the return that is actually seen should always be equal to the expected return, which means there should be no variance, right? In other words, no standard deviation of returns. The return should always be exactly what you're expecting, right? Now, how do you get this kind of a security? You might assume that, the government bonds, or the government issues some bonds and they issue some securities, and that is considered risk-free. In theory, the government can also default. In fact, we have examples in the recent past where we saw Greece, we saw Argentina, we saw these guys default. We are very close to Venezuela defaulting on their debt as well, right? Now, that's the first problem that we see. There's one more condition. When we look at the traditional YTM calculations, remember we say that a bond that gives me 10 and then gives me 10 and then gives me 110, if I am going to discount it at 10% to get the present price of the bond for 3 years, this value will be equal to 100 because this bond would be trading at par. Recall our discussion on fixed income instruments. Now, when this bond is trading at par, there is a genuine assumption into this. It assumes that the intermediate payments, which is this 10 and this 10, get reinvested. It assumes compounding of the principal and interest amount, right? So it assumes that this 10 rupees that we get gets reinvested at the actual underlying rate, which is 10%. So it's like saying I put in a money in a fixed deposit that's going to give me yearly interest for 3 years. Now the money that I get at the end of the first year also gets reinvested at the same rate that was promised to me at the beginning of the first year, not at the end of the first year, right? So for all practical purposes, in real life that doesn't happen, right? So if reinvestment is not the same, then there is going to be a difference in the actual return at the end, because this condition holds true only if the intermediate payments are getting reinvested. So in real life, when you get payments such as coupon payments on the bond, they may not be reinvested at the same rate because interest rates in the markets may have changed. So technically speaking, for a bond to have zero risk, it should by definition have no default risk and no reinvestment risk, right? Now let's understand what kind of bonds have that. So what is a default risk-free security? Now, even the best and largest private companies can default, and they cannot be considered risk-free in the complete sense when they borrow. Only the government is considered to be risk-free in the context of default risk, and this is also in the context of local currency. So if Indian government issues INR bonds, this is going to be considered as default free. Why? Is because the government can resort to printing money to pay off the local currency debt. That, however, does not work if the Indian government is issuing a dollar debt, remember. So the default risk-free security is going to be always in the local currency, right? The second thing is that we don't want reinvestment risk. So how do you remove reinvestment risk? You can remove reinvestment risk if you can remove the coupon, right? So if there is no coupon, then that's called a zero coupon bond, correct? You can have a bond that gives you 10 and 110. On the other hand, you can just have a bond that gives you 121. If you invest 100 and you invest 100, and this is year 1, this is year 2, this bond also gives you 10% return, and this bond also gives you 10% return. But the second bond is a zero coupon bond because there's no coupon, and hence, because there is no intermediate payment, there is no risk of intermediate payment being invested at a higher or a lower rate. So there is no reinvestment risk there. technically, right? So a zero coupon bond is what we would look at. A government bond in local currency is what we will look at. So we have zeroed down on two parts. One is zero coupon bond, the second is the government bond. We've still not answered the question of how long the tenure should be. Should we take a 1 year bond, 2 year bond, 5 year bond, 10 year bond, 30 year bond, right? Now, we'll simplify this a little bit here. While in technique, you would have various cash flows, and this is not very important from us from remembering perspective. You should ideally be dividing them by rate for 1 year, by the rate for 2 years, by the rate for 3 years, and so on and so forth. Now that's a complicated task because then you technically need zero coupon bond yields for each of the tenures of the cash flows. In real life, we don't really complicate things that much. We will try and match the duration or the tenure of our cash flows with the tenure of our risk-free security, right? Now, technically, we are looking at companies which have infinite tenure, right? So we use a long-term government bond yield, and the most commonly available and traded long-term government bond is for 10 years. 30 years bonds are available, but typically the most easily available bond that trades in the longest tenure is 10 years. So you take a zero coupon government bond and you take the longest tenure which is available and which is getting traded, and that would zero us down on the 10-year zero coupon government bond yield for India as the risk-free rate. So that is going to be our broad input into the risk-free rate. We have not arrived at the final risk-free rate, remember. This is one of the inputs that tells us what could be the risk-free rate if you're evaluating a security, right? Now there are a couple of caveats that are there. One important caveat is that we have to remember that the risk-free rate in the analysis that we use should be in the same currency that the cash flows are in. So for example, if you look at a company like Infosys that's listed in India and that is also listed in the US. So if you are evaluating the company in India, you will use INR risk-free rate. If you are evaluating the company in US, you're going to use USD risk-free rate, correct? And that's because when you're evaluating in India, the cash flows are in INR, and hence you can use the 10-year zero coupon bond yield for India. But if you're evaluating the same company, exactly same company in the US, and the cash flows are in US dollars, you will have to technically use the US government 10-year zero coupon yield, right? That is what will give you in an ideal scenario a correct valuation. Otherwise, the valuations could be different. And why could they be different is because India's 10-year government bond yield is 7.4%, US is 1.4%. So theoretically speaking, if you discount the same set of cash flows by a smaller yield which is available here, that's going to give you a different result. But in reality, the result will not be different because your cash flow in INR will get adjusted to cash flow in USD, and once you adjust the cash flow in INR to USD, it automatically will give the similar value in whatever currency you want to value an underlying asset, right? We look at the 10-year government bond yields for some of the countries. Most of the developed world as we speak is around a very low rate regime. You look at US, you look at Japan and Germany are actually interesting because they have negative yields, which means if you're buying the bond at 101, at the end of the tenure you're getting 100. That does not make too much sense, but that's how the world is at this point of time. UK has rates at 0.8%, France at 0.2, you look at Canada at 1, Australia at 2, Spain at 1.2, Italy at 1.2. The ones which are higher are typically emerging markets. So you look at Brazil, you look at Russia, you look at India, you look at Mexico. These are all emerging countries that are at a higher rate, higher risk-free rates, right? And why is risk-free rate higher in these countries? Because it's in a sense proportionate to the inflation that you see in those countries. So in these countries, inflation is around 5%, 6% at the very minimal. In Brazil, inflation is close to about 14 to 15% as we speak. So from that perspective, interest rates are going to be a reflection on what is going to be the inflation in a particular country. Higher the inflation, typically you'll expect interest rates to be higher, right? That's the 10-year government bond yields. Now, is there anything as completely risk-free? Let's revisit that question. What if even the government is not considered risk-free? So if the Indian government was considered risk-free, recall that we had the various ratings that were there. The bonds rating should have been AAA, but that's not the case. The Indian government bonds rating is something called as Baa3 by one agency and triple B minus by some of the other agencies. Now there is a difference between this, and the difference is in terms of the risk, which basically means that there is a finite risk that all these rating agencies believe that the Indian government may also default. Now, unless we kind of find what is this risk, what is the quantification of this risk, we cannot really come back and say what is the exact risk-free rate for India. That's not possible for us to come back and say, right? So let's try and identify what is going to be the exact risk-free rate. India's rating by global agencies like Moody's is Baa3. This means that we are, the lower to medium grade kind of risk, and the rating states that obligator has adequate capacity to meet its financial commitments. However, any adverse economic conditions or changing circumstances are more likely. So there are two terms that are there. One is adequate capacity at this point of time to be able to manage your financial commitments. The second one is you're more likely to lead to a weakened capacity. So it does not take too much for this set of companies to kind of end up defaulting. Now, how do you really find out the difference between AAA and Baa3? The answer lies in the yields. So if country like India and the country like US are both issuing dollar bonds, there is going to be a difference in the yields, right? What is the difference in these yields? This data is actually put up by Professor Damodaran on his website every year, updated data. These are what are called as default spreads in basis points, right? So effectively, if we are saying that a AAA rated dollar bond is trading at 1.5%, you keep adding this. So AA1 will be at 1.94%, right? Remember, these are basis points, and 100 basis points is equal to 1%, right? The next one is going to be 2.05%. So it all starts with the first one, and remember, these are all in dollar terms, right? Then you look at 67, so that's going to be 2.17%, 2.28%, and so on and so forth. Now, India's rating is this. This is where India falls in. So we are at 2.44%, right? So technically, if India was to issue a dollar bond and US was issuing it at 1.5, we should be issuing it at 3.94%. But that's, remember, for a dollar bond if India issues. Logically, this 244 basis points or 2.44% should be the India specific default risk. Correct? That should be the India specific default risk. So if I subtract this from the current 10-year zero coupon INR bond yield, right, which is 7.4%. Remember, this is for Baa3. Even in local currency, our rating is this. We subtract this spread, what we get should be approximately AAA in INR. So 7.4% minus this 2.44 is going to give me approximately 5%, and that's the RF for our calculation, 5%, approximately 5%. So if Indian government was AAA rated, right, this is assuming that if Indian government was AAA rated, you are going to have an yield which currently the bond yield is 7.4%. You subtract the spread. Where are these spreads available? These spreads are available on Professor Damodaran's website. He collates this for all the countries, ratings for all the countries, and then combines and gives this risk metric and this parameter. Makes it easier for all of us to kind of look at these numbers and evaluate these numbers, right? So therefore, the risk-free rate in India is going to be the 10-year zero coupon bond YTM minus the spread. Remember, this 10-year zero coupon bond YTM is BAA3, and the spread is the spread between AAA and BAA3. So if you subtract the spread, what you get is approximately 5%, which is what should be the risk-free rate in Indian rupee bonds. Correct? You can look at a set of global ratings. In fact, Wikipedia gives all of these broad ratings, and here, when we say triple B minus or triple B plus, which is corresponding to BAA3, BAA1. So typically in one of the rating agencies, which is Moody's, you have this rating, and in another one you have like S&P, you will have this rating, right? What's the difference? So there are certain parameters that put you in triple B. If you're improving, you go to A. If you're not improving, you go to double B, right? Now within this, there could be a company that is doing, or a country, slightly better. You put that here as triple B plus. You put that here as triple B minus. We are here. We are here just above the double B rating, and we can fall there. So what this does is it obviously shows orangish color for all triple B's, triple B plus, triple B, and triple B minus. We are in triple B minus here, right? The dark green ones are the ones which are the safer ones. So you see Canada, some of the European countries, Australia, US, etc. These are the safer ones, right? The blackish ones are the troublesome ones. So you see something here, you see something here. These are the ones where there could be a little bit of a trouble that you could face, right? So that's broadly the contour of what the global ratings are, and that's about it in our risk-free rate calculations. Let's finish this particular section with a couple of questions. What are the key features needed for a security to be considered as risk-free? What are the salient features of a completely risk-free security? And if a country's rating is A3 as per the table earlier, what would be the risk-free rate if the zero coupon bond yield is at 6.1%? Local 10-year zero coupon bond is 6.1%. Rating is A3. So we are looking at this table here. A3, 133 basis points. That's the question. How do you find what is the exact risk-free rate for this particular country? Thank you.